Good morning. Welcome back to Market Monday. It's been about a month since our last video, and a lot has happened. We're certainly glad to be back with you. Well, it's the ultimate tug of war between the bulls and the bears right now. For the bulls, we have moderating inflation, still a decent economy, and strong employment. For the bears, we still have some pockets of stubbornly high inflation, a Fed that's hiking rates at a very fast pace, causing a ripple effect throughout the economy, and the ongoing war in Ukraine, causing an energy crisis in Europe, not to mention the human tragedy, an extremely strong dollar, also causing its own ripple effects. Did you miss us?
Exactly. Maybe not the most uplifting welcome back, but as investors, we will inevitably experience these times. They are unavoidable and are a feature of investing. That's why over time, investments that have risk and volatility like stocks tend to have higher returns compared to a savings account that has no risk.
Since our last video, the Fed did raise its overnight rate again, bringing that rate to 3%. For some context, here are the last 6 hiking cycles. Purple and dark blue lines were in the 80s, yellow and red, mid and late 90s. This long, slow cycle started in 2015 and lasted 3 years. Then we have this year in light blue. We can clearly see the pace of hikes has been the fastest, certainly in the last 40 years of hiking cycles at least, which is a cause of concern.
But again, going beyond the headline, we should remember not all hiking cycles start at the same level. For example, this 1994 cycle here, it also ended with a 3% increase in the rate, same as we are in this cycle. This is the same 1994 cycle here. See where it starts? It starts at 3% and added another 3%. This current cycle started at 0 and went to 3, which is where the 94 cycle started. So we think that does matter, where rates are at the start of the cycle and how far do they actually go.
And again, here's this same 2015 hiking cycle. Small, consistent hikes starting from 0. During that time, we couldn't buy inflation. So this time having started at 0, again, like in 2015, but this time with nagging and persistent inflation. Hence the fast hiking cycle.
So here's the Fed's conundrum. Well, inflation isn't good for the economy, stocks, so we're going to hike rates to slow the economy, possibly causing recession, which also isn't good for the economy and stocks, but may help with inflation. The Fed, of course, is still after that elusive soft landing, but it feels a bit like performing surgery with a machete.
One positive outcome is, look at this, the yield on a 1-year treasury. Right about 4%, US treasuries are considered risk-free assets. Look, 1 year ago, this rate was basically 0. And now you can receive 4% yield on a risk-free asset and get your money back in 1 year. Pretty interesting. You actually have to go back to 2008 during the GFC, global financial crisis, to see rates at these levels.
That's great and all, but that doesn't really help investors who own bonds before the rise in rates. As we know, that's caused bonds to sell off and be a huge disappointment in terms of diversification, especially in a year when we really needed that diversification. So what's a bond investor to do? Do we give up on bonds? Is there maybe a silver lining here?
Currently, the 10-year treasury yield is at 3.85%. Looking at the percentage of time the 10-year treasury yield spent in various ranges since 1945, that's over 75 years. We can see the current yield of 3.85% places it in a range where it spent a quarter of its time. Interestingly, the 10-year treasury yield spent an equal amount of time in the next higher range from 4 to 6%.
But what does that mean for bonds as an asset class? First, we have to extend our time horizon out more than 1 year. This blue line here is the starting yield, so right now we're at 3.85%. The orange line is the 1-year annual return. Lots of noise, it doesn't show very much. But when we zoom out to the 10-year return for bonds at a given starting yield, there seems to be a fairly tight correlation between the two. So before this hiking cycle, when yields were very low, folks seeking income from their investments used to describe the market with the acronym TINA, there is no alternative. Meaning if you needed a reasonable yield, say 3 to 5%, you had to own a dividend-paying stock because bonds simply couldn't deliver that yield. Now, folks are describing the market as Terra. There are reasonable alternatives. Even CDs are offering rates not seen in a very long time.
Since the Fed is hiking quickly to tame inflation, or at least to maintain credibility, let's see what's going on with inflation. Here, we're looking at CPI inflation and various paths back down to under 3%. Remember, the main CPI number is a year-over-year calculation. But with every month CPI release, the month-over-month inflation numbers are getting more attention. So even if we have positive 0.2% month-over-month inflation going forward, headline CPI inflation will be under 3% by next summer. And if we have negative month-over-month inflation, could even be under 3% by spring. This would likely allow the Fed to stop hiking rates and maintain credibility still.
Looking ahead to earnings. First, let's remember, earnings is really what drives the stock market over time. That's how we can have a higher and higher stock market over long periods of time. Decades is how we like to view it. Starting in 1985 with around $20 of earnings per share, and now we're around $225 of earnings per share. And you didn't have to lift a finger. The only thing you had to do was tolerate ugly drawdowns like we've seen this year. The rest was done for you.
On a slightly shorter term basis, the market focuses more not just on the level of earnings, but on earnings growth. Ignore these colored lines here. Looking at the gray bars, which is earnings growth, we see this ebb and flow pattern. Earnings growth increasing through 2017 and 2018, peaking in early 2019, and largely due to COVID, had negative earnings growth, and early 2021 flipped back to positive earnings growth.
What has folks concerned is being on the downward slope, which is called slowing earnings growth. The problem is, no one knows if earnings growth continues slowing, even going negative. That's the earnings or profit recession you're likely to hear about, where we get negative earnings growth. Or will earnings growth stall out like it did in 2016 timeframe and not go negative to create that profit recession scenario, but was just taking a breather before taking that next leg higher?
And for today, we'll wrap up with midterm election years. Now, there may be some voodoo associated with these types of seasonal patterns, but for some reason, midterm elections produce oddly consistent stock market results. For example, midterm election years tend to have higher average drawdowns and tend to grind lower throughout the year until right about now, early October. Then the one-year performance after midterm election years, this year on November 8th, has been positive every single time going back to 1950. Every single time. This shouldn't be the only reason we invest in the stock market, but that level of consistency is pretty remarkable. We'll see what this year brings.
All right, lots to think about out there. It was great to be back with you. We hope you enjoyed our video. Have a great week.